So this session is going to be a little bit different than the previous ones in that we will start with Chris Giancarlo, the crypto dad, to give a 10 to 15 minute remarks, and then each of the panelists will give their shorter remarks and start discussing the topic that Chris is going to talk about. The moderator is Professor Chris Brummer from Georgetown Law School. And so he's well known for organizing the best and largest fintech conference in DC, and it is coming in November. So stay tuned. Yes.
Thank you so much. It's terrific to be with you. Having put on a few conferences myself and here with the conference meister, Chris Brummer, about putting on conferences, we know that the secret is a lot of hard work, a lot of attention to detail, assembling the right panelists, assembling the right audience, and a little bit of magic to make a great conference. This conference has all of that plus a lot of magic. So really a big hat tip to our host today, the Philly Fed, for putting this on. It's a great program. It's really a pleasure to be here. I'd like to begin with a comment made by former governor of the Bank of England and the Bank of Canada, Mark Carney, who wrote that the value of money requires not just the belief of the public at a point in time, but critically the consent of the public at all points of time. And he went on to say, when it comes to money, the consent and trust of the public must be nurtured and continually maintained. So I'd like to speak about shortly, not just the value of money, but the values inherent in the digital money of the 21st century and how we go about gaining the consent and the trust of the public in the digital money that's to come. My friends, modern money is changing. It's expanding from fungible cash bills and electronic notations on the balance sheets of central and commercial banks to unique digital notations on new digital infrastructure operated by both global decentralized collectives and national sovereign governments and private sector entities. In short, the internet is doing to finance, banking, and money itself what it's already done to information gathering, retail shopping, entertainment, photography, social networking. It's so much that I could go on with. And what is that? Well, it's to increase efficiency and automation, lower costs, further inclusion, unlock new business models, and threaten and challenge a whole lot of traditional market structures. Amid such change, it's time to consider the process of nurturing the consent and trust of the public in this quickening digital future of money. Today, well over 100 foreign governments, representing 95% of global GDP, are exploring various forms of central bank digital currency. That includes 19 of the G20, with China placing its digital yuan, the ECNY, in over 240 million digital wallets, the EU potentially deploying a digital euro by 2025, and recently the UK proposing to roll out a digital pound by the end of the decade. A Bank for International Settlements survey suggests that by 2030, there could be 15 retail CBDCs intended for everyday transactions and 9 wholesale CBDCs used for transactions between financial institutions. Meanwhile, global stablecoin usage continues to increase dramatically. Stablecoins settled over 11 trillion of on-chain transactions in 2022, almost surpassing the payment volume of Visa and reaching 14% of the volume settled by ACH and 1% settled by Fedwire. The supply of stablecoins has grown from less than 3 billion 5 years ago to 125 billion today. Stablecoin adoption is inherently global, providing basic dollar-based financial services to almost anyone and anywhere with an internet connection, providing an alternative from high inflation currencies and fostering innovation upon new global open network money movement rails. It's clear that both sovereign and non-sovereign digital currency is coming and coming rapidly. It's coming whether we like it or not. It's coming whether we want to ban it or not. It's coming whether there's a criminal element or not. It's coming whether or not the U.S. adopts a digital dollar, digital currency or not. The fact of the matter is many countries are rolling out CBDCs. Many stable coins are growing. And it means that American multinational corporations and citizens at home will be dealing with both CBDCs and stable coins for the future to come. Thus, the fashionable debate between CBDCs and stable coins is already passé. It was always a false choice, and it's now moot. The global economy of the 21st century will include a broad range of ongoing innovation and payments and in money, and contain both sovereign and non-sovereign digital currency. In fact, the success of one may be dependent on the success of the other. In the traditional economy, access to central bank-backed public money, the most risk-free form of money, has always been necessary to support and stabilize bank deposits and all other forms of private money. Individuals have confidence in the safety of their commercial bank deposits, in part because they know that in a crisis, they can withdraw from an ATM physical cash that is backed by a government and its central bank. It's likely that the success of non-public forms of digital money, whether stable coins, commercial bank deposits, or other private forms of payment, will similarly depend on the ready online availability of sovereign digital currency, especially as cash use decreases worldwide. And yet, little is being done by American policymakers to shape and garner the consent or trust of the public in this evolution of money. From some on the right side of the political spectrum comes highly aggressive opposition to a U.S. CBDC based on little more than assumptions about the ultimate design choices. And from the left side comes opposition to developing stablecoin and broader digital asset regulatory frameworks for fear it will legitimize what is already moving mainstream. Clearly, to my mind, more needs to be done in Washington to seek the consent and trust of the public in the inevitable future of digital money. It's almost 4 years since I completed my service at the CFTC, and during that time, the CFTC oversaw the launch of Bitcoin futures, the first and most successful crypto product traded in the United States that is legal, liquid, transparent, and fully regulated. The performance of Bitcoin futures is proof that U.S. regulators can engage successfully with digital assets and do so in a way that garners the public's trust and consent. In January 2020, I co-founded, along with Daniel Gorfine, who's here today, the Digital Dollar Project, a neutral, nonprofit forum focused on exploring digital innovation and money and future-proofing the dollar in this coming world of decentralized and centralized digital currency networks. Now, the Digital Dollar Project does not call for ready deployment of a U.S. CBDC or digital dollar, but it does encourage the U.S. to assert principled leadership in CBDC experimentation at home and digital currency standard setting abroad that is consistent with U.S. norms, values, and the rule of law. When the Digital Dollar Project was founded 3.5 years ago, it was ahead of the curve in seeing the direction of both sovereign and non-sovereign digital money. Now it's right in the middle of it. The champion model that the project published in 2020 is today the most common form of CBDC being examined by agencies of the world's democracies. Some of the work of the project is devoted to real-world testing of the challenges and opportunities of sovereign digital money. And just this summer, the project published the results of its first-of-its-kind study on the retail use of a possible U.S. digital dollar. That study revealed the potential of a digital dollar to reduce counterparty risk, decrease settlement times, expand access, and provide greater visibility and transparency to individuals sending money to loved ones worldwide. The pilot followed on the project's earlier work exploring CBDC for security settlement. Now, what's the big deal of digital currency? Well, we've all heard of the many possible benefits of digital currency, including programmable, instantaneous, around-the-clock payments at much lower cost and greater access to financial services for both retail and wholesale participants. It will hopefully strengthen the ability of governments to implement benefits policy, allowing direct infusions of money across economies, vastly improving upon the administration of payments, compared to the inadequate U.S. efforts during the COVID-19 pandemic, where we used paper checks to people who are locked up at home without access to bank facilities. Yet these are really only initial achievements. Ultimately, the vision for digital currency is nothing less than the prospect of fully networked, integrated economies with digital currencies as operating systems and digital tokens as their value components. In the same way that 19th century railroad and telegraph technology weaved together a series of regional economies here in North America and created a continental economy, the likes of which the world had never seen before, so does digital currency hold the promise of directly linking the world's many disparate, self-contained silos of financial activity into a series of global digital currency-based financial system networks. Well-designed digital currencies, whether sovereign or non-sovereign, can serve as digital operating systems, Microsoft OSs, if you will, for fully networked digital economies, driving far greater efficiency, automation, transparency, and access than ever before. The trajectory of the globe is towards the creation of massive scale, singular currency platforms operated in some cases by central banks and governments, in other cases by private sector entities. The informal currency zones of the 20th century will yield to highly integrated digital currency networks of the 21st. And the governmental and non-governmental powers that realize this vision will gain huge advantage in a digitally networked future. Yet it must be recognized that those digital currencies that prevail, both governmental and non-governmental, will be gathering points for massive amounts of data about the economic and financial activities of users, of citizens, and of voters. Many thoughtful people on both sides of the political aisle are appropriately concerned about misuse of such honeypots of financial data. CFP Director Chopra has called for accountability for commercial misuse and abuse of private financial data. And Florida Governor DeSantis and others are rightly concerned about government invasion of privacy with CBDCs. There is recognition across the political spectrum about the risk of direct access by government to such troves of private financial data, and alternatively, political pressure on private sector actors to conduct surveillance, report on activity, and disable financial transactions with disfavored groups, with heterodox opinions, or activities that are out of sync with the government's actions in a similar fashion to the U.S. government's now increasingly evident censorship of speech on social media. Regardless of the form of digital currency, sovereign or non-sovereign, it's imperative that our society thoughtfully consider privacy implications and design the future of money to be consistent with key democratic laws, norms, and values. Fit-for-purpose digital currency regulatory frameworks, as well as any future U.S. CBDC, must protect citizens' privacy rights if the future of money is to enjoy their trust and consent. In democratic societies, lawful transactions in digital money, again, sovereign or non-sovereign, must be immune from commercial and political surveillance, censorship, and overweening pressure to disable otherwise legal transactions. Without it, private economic activity will be frighteningly beholden to big tech monopolies and the shifting political winds of Washington. That's why the advent of both stablecoins and CBDCs offers the opportunity to reassess contemporary financial surveillance in its entirety. It's an opening to reverse the lamentable trend of overly broad information gathering under the Bank Secrecy Act and replace it with a new architecture that can better assure privacy while effectively and efficiently satisfying legitimate law enforcement and national security concerns. In fact, individual economic privacy and censorship resistance should be affirmative design features and a competitive advantage of a digital dollar, again, sovereign and non-sovereign. Designed right, a digital dollar could run on systems that are operationally and objectively transparent, thus providing the public with independent assurance about technical function, security, and resistance to censorship and impermissible monitoring. Such a design approach, however, will only work if the U.S. is willing to embrace new digital technologies and regulatory approaches for satisfying legitimate national security and law enforcement objectives. As we just heard, brilliant minds, including some here in Philadelphia, are developing privacy-enhancing, or what they call PET technologies, such as zero-knowledge proofs, homomorphic encryption, and multi-party computation that enables parties to prove that an encrypted proposition is true without revealing the underlying private information. Combining these PET technologies with big data analysis, pattern recognition, and other algorithmic methods will allow law enforcement to protect privacy by identifying wrongdoing when it actually takes place, rather than invading people's privacy in case it might take place. By encoding individual economic privacy into its very architecture, a future digital dollar could serve as the desired instrument for Americans and people the world over who aspire to financial autonomy and inclusion consistent with basic human rights and democratic values. So in closing, I return to Mark Carney's realization that money is as much a social construct as it is a government construct. Its success indeed derives from the trust and consent of the ordinary people who place their trust in it. They have as much to gain from the digital networking of the world's financial systems as do governments. But free people must also have much to lose if they're silent in the discussion over what values will be encoded in digital money, whether sovereign or non-sovereign. The world will have a range of digital currency, whether the United States chooses to lead or to follow. The question is not a choice between CBDCs and stablecoins, nor is it whether the digital future of money can be forestalled or banned. It can't. The real choice is between financial freedom and financial control, and the role of democratic society in driving key design choices and related regulatory frameworks. The questions are whether these new forms of digital currency and the digital network economies they power will make societies more open, prosperous, and free. Will they inhibit or empower humanity in the digital future of money? And will they diminish or enhance the worth of our fellow citizens and people everywhere? The choice is between freedom and servility in the digital future, and it's being decided right now. Democratic societies must assert their time-tested principles in a world seeking a sound foundation for a new digitally networked future. Digital currencies that effectively protect financial privacy and lawful transactions will garner the enduring confidence of free people and those around the world who aspire to live free lives. And the nations that foster these digital currencies will win both the economic power prize and the enduring trust and consent of their citizenry. So let's not be afraid of this innovation, but let's seize it and let's shape it in accordance with our finest and most noble values. I thank you very much for your time today.
Well, thanks, Chris. That gives us a lot to think about. I appreciate your thoughtful discussion about CBDCs and other digital assets. And Jalapa, I'd really like to thank you for being thoughtful about my schedule and allowing me to participate today. This is the first time that I've been able to participate in the Philly Fed's Fintech conference, and it's really fantastic to be here. What an incredible conversation to be a part of, and what an inspirational panel to be a part of. These folks that have been talking about these issues for a number of years, and to think about it from the Federal Reserve's perspective, and how I'm thinking about it in particular, but some of the important ways that that I'm approaching it as a policymaker. So first, I want to talk about a little bit of, and as many of today's participants have already discussed, money and payments landscape continues to evolve in the U.S. and, of course, internationally, including through innovations like digital assets, programmable platforms built on distributed ledger technologies, and new types of entities providing payment services. It's incumbent upon policymakers to understand these changes, whether there are opportunities to solve specific problems and the implications for the U.S. consumers, as well as for the broader economy and for financial stability. One area that I'm particularly attentive to, and that is specific to this panel and why I was included in the discussion today, is consumer protection. So here I want to highlight two issues that I find important in the context of money and payments innovation. The first is protecting consumer privacy, including privacy from the government and from other actors. And of course, preserving what works well today within the U.S. banking system, which is supported by a strong framework of supervision and regulation. The U.S. banking system is a mature, well-functioning, safe, sound, and effective system. Banks provide consumers access to credit and other banking and payment services, and they provide protect sensitive consumer financial data, all within that established regulatory perimeter. The U.S. also has a safe and effective payment system that continues to evolve with responsible innovations, like our recently launched FedNow Payments Initiative. And for the money and payments landscape, as it continues to evolve, it's important that we carefully consider the risks and trade-offs that may emerge within this evolution, including the need to balance the privacy of consumers and the transparency necessary to deter financial crimes, and to understand how digital assets and financial activities could disrupt the broader banking and financial system, especially in cases where similar activities are treated differently under the current regulatory framework and perimeter. In my view, safeguarding the privacy of consumers is of primary concern. Financial innovation should not be an opportunity to evade the strong protections we have in place in the banking system. In the past, I've emphasized that we must ensure at a minimum, that the consumer data privacy protections that exist in today's payment systems continue and are extended into future payment systems. But at the same time, we must continue to balance that necessity with the need for transparency required to deter criminal activity. Banks play an important role in balancing these needs, and they do so within an effective regulatory framework. Consumers use financial products with a certain level of trust and with an expectation of privacy. And it's paramount that financial service providers respect and protect that data and that data that consumers entrust to them, and that they manage the risks that are associated with the collection of their information, especially those reputational risks and disclosure risks in the event of a cyber attack. Importantly, the activities and risks involved in financial data collection should be regulated within the same framework, no matter who is collecting the consumer's financial data. The same activities that bear the same risks warrant the same regulations or protections. As an example, banks are held to a specific regulatory standard with respect to consumer data privacy. Bank compliance and reporting programs also support important public policies, including deterring criminal activity. This includes reporting and compliance related to KYC, AML, BSA, and other frameworks that are required by state and federal authorities. But at the same time, the intermediated banking model in the U.S. helps to insulate consumer financial activities from unnecessary government overreach. I think this could be a reasonable model for future financial innovation. This approach to consumer privacy and information collection, balancing privacy and transparency within a consistent regulatory perimeter, can serve to enhance responsible innovation within the financial sector, while still maintaining strong consumer protections. Specific innovations in money and payments, such as digital assets, also warrant careful consideration of the trade-offs and risks they could pose to the stability of the banking system. Banks play an important role in providing consumer access to credit and other banking and payment services. More broadly, the U.S. banking and payment systems play an essential role in the transmission of monetary policy and supporting a well-functioning economy and financial system. And this system works well. Therefore, it's important to understand the risks and the trade-offs that are associated with digital assets and new arrangements used for banking and payments. While I support responsible innovation that benefits consumers, solutions that could disrupt or disintermediate the banking system, potentially harming consumers and contributing to broader financial stability risks, would not be considered responsible. And where this activity occurs outside of the regulatory perimeter, consumers are left without adequate protections. Those that are regulated and supervised banks provide today in the United States. To conclude, as the money and payments landscape continues to evolve, it's important to carefully consider the risks and the trade-offs, including balancing the need for consumer privacy protection and the transparency necessary to deter financial crimes, as well as understanding where digital assets could disrupt the broader banking and financial system, especially where similar activities are treated differently under the current regulatory perimeter. So I want to thank the Philly Fed for including me in today's discussion, and I look forward to our conversation. Thank you.
So thank you so much to Jalapa and to the Philadelphia Fed for having us here today. It's wonderful to be with you, and to all of you for taking the time to attend this conference. So I'm going to just make a few quick, short remarks, relatively informal. So the first thing I want to say, and something that I think people often forget when thinking about the future of money and consumer protection, is that technology is not fixed. Innovation does not stand still. And people will continue to develop new and creative ways to achieve their economic wants and needs, which might include speculation and investing. We're building a very exciting new set of financial rails. And in addition to that, we're in a situation where technology giants with user bases larger than any country control core parts of the mobile payment stack, as described by Director Chopra earlier this morning. So the world is moving ever faster into the future, and people want to transact digitally in many different realms, and that can mean many different things. So the question is, how will this work? And how do we move forward in a way that satisfies this need for change, but at the same time protects users and protects the systemic risks and in our financial system? Well, we've heard some very diametrically opposed opinions today on the value of digital currency in addressing some of these challenges. But I think one thing that people seem to agree on is that the existing system isn't working as well as it should. There are real problems. And something that I think it's also important to note is that we can't really redesign the system from an armchair. It's not possible. We have to actually get out there, try things, have failures, and let things play out. But finance, as I've come to learn as a technologist, is somewhat insidious. It's not exactly a field that plays well with experimentation. It seems like people's creativity to unintentionally or intentionally part uninformed users from their money is unbounded. And we have learned many hard lessons from the past on what works and what does not work. But we still need to have the courage to try, experiment, and fail. I'm heartened by the discussion that we've had here today because it seems like we're getting to another level of nuance in the conversation. Importantly, as Chris Giancarlo echoed, it's not either or. We're not competing. These different technologies and solutions aren't necessarily competing. We're all trying to figure out how we're going to move forward into our digital future together. In terms of consumer protection, I think we need to ask the question, protect from whom? So there is the issue of criminals. There's the issue of predatory finance. There's the issue of government overreach. And there's the issue of intermediaries that might unduly influence the ways that a user can access their funds. So there's a lot to think about in the consumer protection realm. And I think it's also important to note that it's not going to be a purely technology-based solution. These areas, as part of getting to the next level of nuance in this conversation, is recognizing that there's no easy answers here and there's no simple technology solutions. It's going to be a combination of experts working together across many different areas, experimenting and being willing to fail and learn from those failures. Thanks.
Well, let me start by thanking the Philadelphia Fed for hosting this and for inviting me. I appreciate the chance to be here. I would like to point out briefly that my affiliation with Apollo is on the board there, but I want to be clear. I'm on the board of Apollo, but I do not speak for Apollo. I speak just for myself. I want to start by tipping my hat to Chris and the work that he has done to foster what I think is a very, very constructive and important conversation about imbuing any kind of digital currency, any kind of digital dollar with American values. And for me, one of the priorities, and I know it's a priority for Chris and so many of us, one of those values is our privacy. It is an intrinsic part of our freedom, it seems to me. And that is one of the reasons why I remain a bit of a skeptic about a central bank digital currency, not because I think it's impossible to maintain privacy, but that would be an extremely high priority for me. I also have some questions about frankly, how quickly the Fed's technical ability would enable it to actually roll this out and deploy it. And I would point out there is no legal authority standing today for a central bank, a CBDC issued by the U.S. government, and it certainly should not be pursued without that. Having said all that, I think I remain open-minded about this, and I think we should continue this discussion. Chris made the point that this doesn't have to be an either-or between CBDCs and stablecoins. Stablecoins are already here, and I don't think they're going away. I really don't. I actually think there's tremendous potential, and I'm not a technological person, but just intuitively, when you consider the idea of moving value as easily as we move information instantaneously, virtually for free, anywhere in the world without an intermediary, that just sounds very interesting to me. The idea of tying it to an exogenous event that's verifiable, that seems like a tremendous potential. And I kind of approach this with the humility of the guy that remembers when I first learned about emails, it never occurred to me that there would be an Amazon or an Uber. It took a little while for that to come along, and I suspect I have the same limited imagination today with respect to digital money as I had then. So I'm of the view, and I spent 2 years, my last 2 years in the Senate. I was the ranking Republican on the Senate Banking Committee, and I made no secret about my top priority. My top priority was to try to pass legislation that would create a sensible regulatory framework for stablecoins so that we would enable Americans to really thrive in the development of this new technology with appropriate guardrails that would protect consumers, among other things. Obviously, I failed spectacularly at that mission, but it is still underway. And of course, there was a recent milestone reached when the McHenry legislation was passed out of the House Financial Services Committee, the House counterpart to the Senate Banking Committee. Had a bipartisan vote, although it was lopsided. There was a bipartisan vote. And the legislation contained many of the basic things that we would all, I think, expect to have in a stablecoin bill, such as the requirement of 100% cash and cash equivalent backing, the requirement of transparency, the requirement of having audits. Interestingly, one of the sticking points, one of the most controversial points, is the question of whether there should be essentially exclusively a federal path to be able to issue a stable coin, or whether there should be multiple paths, which would include state regulators. And obviously, we have this dual state-federal combination in other contexts. We have it for banking charters. The entire insurance industry is regulated exclusively by the states, pretty much. So I happen to think that that's a very constructive way to pursue this. But this is one of the outstanding issues that is going to have to be resolved. I don't know how this ends. It's difficult to see how stablecoin legislation makes it all the way into law in this Congress, although It is conceivable, and we could discuss that further. But I just want to say I think it's really, really important that we create this regulatory framework, provide certainty for the developers and all kinds of folks that want to be active in this space. And my last point is, even if I can't imagine a physical world application that's in big demand right now for stablecoins, I suspect there's a reason that Visa is pursuing a stablecoin venture. I suspect there's a reason that PayPal is moving in this direction. And thinking more broadly, I suspect there's a reason that all the biggest asset managers, not all, but many of the biggest asset managers in America want to have Bitcoin ETFs. This technology is really, really interesting. I think it's here to stay. I think it has tremendous potential. And the role of Congress, I think, is to create clear rules of the road that protect consumers and allow the development to flourish. Thanks.
Well, thank you. The role of a good moderator is actually to be as invisible as humanly possible. And with 4 speakers like these, that's a delightfully simple thing to do. I'm just going to ask, I think, 2 questions and then ultimately end up with our audience. The first being a little bit more practical on this theme of experimentation, and then we can get circle back into the meat of politics. But I did also want to make an acknowledgement, like everyone else, as we end this final session, pulling off a conference like this with these speakers. Bravo. It is hard work. So congratulations. One of the issues that we've heard from really all of you is this question of what do you do when you're facing the unknown? And Governor Bowman, I was struck by this idea of the trade-offs, because sometimes when you're trying to measure trade-offs, you're measuring trade-offs with very limited information. And so there are questions as to how then do you generate more information to create judgments on those. It's a question that Chris Giancarlo had to deal with when he was thinking through the Bitcoin ETF issue. It's a question that obviously engineers over at MIT try to really deconstruct in their work, both practically and on the policy end. But how do you go about creating an environment when we get to these political issues where you can start to better define both trade-offs and risk and opportunities, when really the parameters for that experimentation can be constricted for any wide variety of reasons?
Well, of course, that's a great question. This is working.
Yeah,
okay, great. And I think this panel in particular is fantastic with a demonstration of how the Fed approached CBDCs in particular. I've known Neha now for a few years because of her work with the Fed and doing experiments and technology on how CBDCs might be used and the technology that might support them into the future. Whether or not, as former Senator Toomey said, there is authority from the by Congress for the Federal Reserve to move forward with the creation of that. It is important that we understand the use cases, the business cases, all of the why there might be innovations in the payment system, whether that's CBDCs or other innovations. And it's important that we take the time to carefully inquire, probe, and understand whether or not those are things that should be included in some kind of a regulatory framework, and then work with Congress or discuss those issues more broadly through a research perspective to understand how they might be included in some sort of a construct that would protect the financial system, financial stability, and consumers.
Chris Giancarlo, we've talked about this for I don't even know how many years, and one reason why you inspired my conference by telling me to throw one over in Washington, D.C. So, I mean, how can you get the government to actually create that data through experimentation and to get to better policy outcomes?
It's hard. History is filled with mature late generation societies eventually deciding that the best way to protect stability is to protect the status quo. In the face of technological change, sometimes the best way to maintain stability is to actually accept change and not try to resist it. And I think we seem to be in that part as a well-developed society with a very well-functioning, for the most part, financial system, a financial system that allowed us to dominate the 20th century, with our banks being the top of the hill, our currency being the top of the hill, our central bank being the top of the hill. But we have to, I think, do what Americans have historically done best and return to some of our triumphs of the past and be unafraid of this technological change. Let's figure out how do we future-proof the dollar in a world, and it's not just digital networks that are coming. It's AI, it's quantum computing. You know, we're almost like deers in the headlights with this change coming. And if we just try to hold to the past, I'm afraid we will fail. We must be unafraid to work with this innovation. And that doesn't mean just go wild and let anything go. You know, I think what we did at the CFTC by not resisting Bitcoin futures, but working and putting a regulatory regime around it, I think is a bit of an approach that we should have as a whole of government. Let's not resist this innovation, but let's seize hold of it. Let's channel it. Let's direct it. Let's put proper regulatory regimes around it, as Senator Toomey strove to do when he was in the Senate, as others are doing. Let's embrace change as we've historically done as a society and benefit from it.
How do universities deal with that issue? You know, you yourself acknowledged, Neha, you know, you're dealing with technology that's always moving. You're literally trying to experiment with something that is a moving object, but at the same time, you have to create usable data. I mean, are there lessons that people in the audience can learn from some of the work that you're doing?
Yeah, I think one of the biggest lessons that I've learned is that, you know, even if you're doing technology research, you're not doing that in a vacuum, and people have a lot of opinions about money. That really tends to get people pretty fired up. And so, you know, seems pretty obvious in retrospect, but I think I didn't really fully appreciate that as we started entering into some of this work. So I think you have to be cognizant of the context. Something that I think about a lot, I know we've heard a lot of analogies today, and people like to analogize digital currency technology to the internet, but something I do think about a lot is the fact that the internet had the opportunity to develop almost in quiet for a very long time. It was sort of seen as this sort of research network for scientists sharing data. You know, the commercial aspect to the internet didn't really come about until much later. And that hasn't really been the case in the digital currency field. And every digital currency post Bitcoin has sort of had that huge meteoric rise and valuation and speculation and people getting very, very wealthy. And so it's been very difficult, I think, to do this work in a neutral way, given just how much money and speculation there is in the space and what the way that leads people to even talk about what you think are relatively objective issues that might be able to be based on data. It all sort of becomes very warped. And so that has been quite challenging. And I think, you know, in the university context, I'll just say that I don't think, at least personally, engineers are very good at dealing with this sort of very sophisticated context. MIT does not have a policy school that we could lean on. There's a great one down the street at Harvard, which I hope we can work with more closely, but and maybe Georgetown.
It's a pretty good one in
yeah. I think there's a great one in DC as well. So you know, again, and I've said this numerous times, we have to bring technologists and policymakers together. I think that when I look at the field of economics, that's a field where I see that policy has really figured out how to adopt that discipline and expertise and bring it into their world. I have not seen that as much with technology and computer science, and I think that's going to be a really important skill to develop going forward.
You know, it's interesting to be hearing that as like from a law professor's perspective, because I hear from regulators all the time, and when they were in office and after office, and they talk about how difficult it is for regulatory agencies to experiment, even just do procurement rules, what employees can use or not use. And, you know, universities are like, hey, Chris, can you give us some computers for us to like experiment with, you know, digital assets? I mean, very, very interesting kinds of requests made by government just because of sort of basic, kinds of hurdles. But then when you throw in things like the political questions, right? DC is a political town, and that informs obviously not just our elected officials and not just the heads of regulatory agencies, but also the behavior of civil servants, right? And that then creates its own interesting dynamic. Cracking that political nut in terms of just moving forward in a way in which there is a policy, that's I suppose the gold mine, right? I mean, for solving any kind of issue, whether or not it be in digital assets or AI. Where do you see as you look forward, as opposed to just back, where do you see the particular frictions that need to be solved? And are any of these frictions politically any different from the frictions that we've seen over the last 6 months to 2 years? In other words, has there been any political progress made? And are there fewer frictions than before? Are they different in nature? What kind of political prognostication and frankly, practical prognostication can you maybe afford us and for those in TV land?
I've got a very cloudy crystal ball, just to be clear. But look, it's tricky. So my hope, especially a year and a half ago, 2 years ago, was that there was a window of opportunity to do something on stablecoins first, and I think we need broader legislation as well, like market structure legislation for crypto more broadly. But that's much more complicated. Stablecoins are easier to understand. They're easier to analogize to other existing instruments. So my hope was we could start there. There's bipartisan support for, say, the McHenry bill in the House. In the Senate, this is public information. It's no big secret, right? The most outspoken Democrat members on this issue are deeply skeptical about crypto and extremely resistant. And I think that's a case for why they ought to want a regulatory regime that would put up some guardrails. But I think, honestly, that there's a concern among some of them that any kind of legislation and subsequent regulation validates the technology, and they don't want to see it validated. So it's challenging. I could speculate about different scenarios in which something might happen. I had thought that the collapse of Terra and Luna would suggest that maybe it's time to provide some consumer protections here. But obviously that did not come to pass. I would just say that, I think there's a reasonably good chance that there will be a successful vote in the House, that the vast majority of Republicans will vote for the McHenry bill on stable coins, and a significant minority of Democrats will vote for it as well. I doubt that it gets taken up in the Senate, to be honest. But if there's a significant bipartisan vote in favor of it in the House, it's a starting point. And the legislative process can be slow, but that is a significant step forward, and it could lead to passage in the next Congress.
Wow, that was like perfect that someone says the word stop. Literally within a half second of that. So apologies. I'm sure that the audience will have an opportunity to catch you outside. Thank you so much to all of you for